Hey everyone, welcome back to the show. Thanks for tuning in. My name is Mike, this is my whiteboard, and today we're talking about the Iron Condor Trader Checklist. So we've gone through the rest of the week with a few other strategies, and we're going to finish out this week with the Iron Condor, which is a defined risk neutral strategy. Next week we're going to take a break from the checklist, but I did get a lot of great feedback, so we're going to continue on the following week with the remaining strategies that we use most commonly. But today we're going to be talking about the Iron Condor specifically. So what is the Iron Condor? Well, if we go to the next slide, we'll break it down for you. It's really just a short put spread that we're selling, along with a short call spread that we're selling, and both of these spreads are going to be out of the money. So since we're selling an out-of-the-money call spread and an out-of-the-money put spread, we're going to be able to route this trade for a credit. We're going to pretty much straddle the stock price with these two spreads, and the goal of this strategy is very much like the short strangle, where we want the stock price to be between our short strikes at expiration, because that will allow our spreads to expire completely worthless, and that credit we received from the original trade will be turned into full profit, because there won't be any more position on when those options expire worthless. So this is a delta neutral strategy, and it's defined risk, and these are two keys of the strategy. The first one being delta neutral. We have that delta neutrality because we have that short put spread, which is normally bullish, which would have a positive delta, along with a short call spread, which is bearish and normally has a negative delta. But if we sell both of these spreads at the same time against that stock price, we have the bullish spread battling against the bearish spread, and the positive deltas on the put side will obviously offset the negative deltas on the call side, which is how we get that delta neutral strategy here. And it is defined risk. So unlike the short strangle, where we're dealing with just this short call that's out of the money and just the short put that's out of the money, we are purchasing these out of the money options to define our risk and lower our max loss, but in turn we are lowering our total credit, because at the end of the day we do have to purchase these out of the money options, which is going to lower that credit we receive from the trade. We do have a neutral assumption, and usually this is a strategy that we'll deploy when we don't really have a bias either way on an underlying. We're not too sure if it'll go up or go down, but we believe it'll stay within the range here. And again, whenever we're selling any sort of premium selling strategy, and anything where it's a basic strategy where we're just dealing with a couple of contracts here and there, in this situation where we're not using any ratios or anything like that, our IV environment is going to be ideal when it's high, and we'll get a little bit into that in just a few minutes. But first, let's talk about this strategy and what can happen when the stock goes up, stays the same, or goes down on the next slide here. So there's a few things that can happen when the stock goes up, stock stays the same, or the stock goes down. The green value is what we want to happen, and these orange values are situations where we can get into trouble, but not necessarily. So we'll first start talking with the stock going up. So when the stock price goes up, there's a few things that will happen to this spread. The very first thing that'll happen is that the call prices will increase, just like a short strangle. The call side is going to increase because these options are going to be closer to being at the money, which is going to increase the value of those options. The lowest value options are options that are very far out of the money, and as they move closer to being in the money and as they go in the money, the options gain value. And since we sold this option and we purchased this option for a lower value, we have a net credit. So really the short option here is what's going to be affecting our P&L on this situation. So if I sold a short call spread for a certain value, and now that value has gone up, I know that I'm going to have to buy back that short call spread for a higher price if the value is up there, and it's going to result in a negative P&L. If I sold something here and the price is now higher, I'm going to have to buy it back at that higher price to close the position. So when the call prices are increasing, that's going to be bad for the situation. But we do have the opposing side where we have the put prices, and those are going to be decreasing. Because if the stock price is going up and these options are going closer to being at the money or in the money, our short put options are going to be, I should say our short put spread is going to be further and further out of the money. Because if the stock price is moving up, these options are going to, of course, stay there, but they're going to be further out of the money than they were originally. And because of that, they will lose value, which is good for our position. So I have this highlighted in orange because Really, the worst case scenario is for the stock price to go through our short call and our long call, which would put our spread completely in the money, and we would probably see close to max loss as we get closer and closer to expiration. But if the stock price moves up just a little bit, we're going to be okay with that, especially if it happens over time, because the options are going to be decaying at a certain rate, which we call theta decay. And that's what we want to happen in this spread, because we're selling this option spread. We want theta decay to work over time in our favor, and we want the stock price to stay within this range. So we know that the stock is probably going to move maybe up a little bit or down a little bit. So if it doesn't move too much, then that's where we're okay with that situation, which is why I have this in orange as opposed to red, because the stock going up doesn't necessarily have to be totally a bad thing. But ideally, we want the stock price to stay the same. If the stock price stays exactly the same, then this would be the perfect scenario. We would have theta decay working for us, and again, theta decay is just the rate of the decay of an options price over time, all else equal. So if I was to freeze implied volatility factors and freeze the stock price movement, our options should decay by that value that you see over time. So that is the perfect situation, because if I use the example again where we sold a spread here, if our spread is decaying little by little over time, that allows us the opportunity to buy it back at a lower price, and the difference would be our profit. So that is the perfect situation and exactly what we want when we deploy an iron condor. But if the stock goes down, it's going to just be the opposite of when the stock goes up. So when the stock goes down, our put prices are going to be the side that actually increases, and our call prices are going to be the ones that decrease. So as long as the stock price doesn't go down too far, where it would be putting both of these options in the money, as long as it goes down just a little bit, we're going to be okay with that, because we know that we should expect some sort of movement, and if it stays within this range at expiration, all these options will expire worthless, and we'll be able to use that credit that we originally received as our profit, since our position would disappear. Another thing I'd like to say about this one is that implied volatility is going to be a factor, but it's not going to be as much of a factor as our short strangle. And that's because we have these long options, but we're going to talk about that in just a bit. So on the next slide, we're going to break down a few of these, and the very first one is just going to be how we calculate our break even. So our break even is going to be very similar to the short strangle we covered, where we're looking at two different sides. So on this one, very much like that short strangle, we take the total credit we received and we use that value and adjust it against our short strikes to determine our break even. We don't need to determine exactly how much we collected from the call side or exactly how much we collected on the put side, because only one side can be losing. The stock can't be up and down at the same time, putting all of our spreads in the money. Only one side can be tested, the other side would be untested, and if the stock were to go down, it would be just the opposite. So the put side would be tested and the call side would be untested. So only one side can be a loser, which is why we take that total credit and we use that value to calculate our break-evens. So to calculate our break-even on the downside, all we do is take our short strike here and subtract the total credit. So let's say our short strike's at 50 and I collected $1 for this trade. If I collected $1 and my short strike is at 50 on the put side, all I would do is take that dollar and just move it one strike over. So subtracting $1 from 50 brings us to 49, which is where our break even would be on the downside. Now let's say our call strike here is at somewhere like 70. So our short call is at 70, and if I collected $1, I would add that to our call strike, because we need to remember when we're selling premium, our break-evens are always going to be improved. So on the upside, my break-even would be improved to the upside, of course, and when I'm looking at the put side, our break-even would be improved to the downside. So here, if I've got a strike at 70 and I collected $1, my break-even would just be at 71. We don't take into consideration the long options when we're calculating our break-even, because the long options are there just to define our risk. The long options are going to decrease our total credit, which is going to indirectly affect our break-even, but we don't need to take into consideration these long options when we're actually calculating that break-even. It's just going to be looking at the short strikes and using our total credit, whether we're subtracting it from the put side or adding it to the call side, to determine that break-even. So with implied volatility, the higher the IV, the better, but it's not going to have as much of an effect as if we were to compare this to something like a short strangle. A short strangle, we're selling these short options and we don't have to purchase these long options. The interesting thing is that when we're in a higher implied volatility environment, all of these options are going to be worth more. So although I'll be able to collect more on my short call and on my short put in a higher IV environment, I'm also going to have to pay more to define my risk with these long options here. So although implied volatility being high will definitely affect the spread and make it a much better situation for us, especially because if implied volatility decreases, we may be able to close this trade out for a winner much faster. But the effect that it has will not be as powerful as something with a naked option strategy. And that's because we have to remember we're always buying these options here, and even in a high implied volatility environment, we're going to have to pay more for those options to define our risk, rather than if we were to look at something like a naked strategy such as a short strangle. We do look to close this trade at around a 50% max profit. And one thing I want to point out is to make sure that when we're doing this, we're calculating everything and taking all things into consideration. So with iron condors, the interesting thing with this is that we're actually using 4 contracts as opposed to 2 when we compare it to a short strangle. So our commissions are effectively doubled. So if I'm collecting 50 cents or 40 cents or 30 cents for this iron condor, I might consider not managing it at 50%, because if I collect 30 cents and I'm managing at 50% of that, that's only 15 cents. And if I'm spending commissions to get in and get out, that might eat away at my profits entirely. So if I'm looking at something like a wider spread where I'm collecting maybe $1 or $1.50, then of course I'll look to manage my profit at about 50%. But we always need to make sure that we're taking all things into consideration. And for a standard iron condor, the ideal setup we look for is for collecting 1/3 the width of our wings. So when I say that, I'm looking at the width on this side, which for a normal iron condor should be equidistant to the width on our put side. So let's say I've got a 3-point wide call spread here, so we use the 70 short strike. That would mean that I would be buying the 73 long call. And on the put side, if I was selling a 50 strike short put, I would be buying the 47 long put. So that gives me a 3-point wide iron condor on each side. So if I was looking to collect 1/3 the width of those wings, I would look to be collecting $1. If my wings are 3 points wide or $3 wide, I would like to collect $1, because that's going to put me in a nice scenario where I have a probability of profit of around 70%. It's going to be probably closer to 67%, but it gives me a nice risk-reward ratio, and it's going to allow me to put these strikes pretty far out and away from the stock price to give the stock price some room to breathe between our short strikes. So our ideal setup for a normal iron condor would be 1/3 the width of the wings. But this has been a lot of information, so let's wrap it all together with some takeaways for you. The first takeaway here is that just like the short strangle, we have a neutral range bound strategy. So instead of just selling the put side or just selling the call side, we're selling them both together. They have differing directional assumptions, but because of that, we create a profit zone, and therefore we have a neutral profit area that we can be profitable by. As long as those short strikes expire out of the money, those long strikes will also expire out of the money, and we'll be able to collect that premium and turn it into profit at expiration if that happens. High IV environment is best for this strategy because at the end of the day we are selling this premium, but it's not going to be as powerful as that short strangle because we are going to be defining our risk by purchasing those long options. We do like to close the trade at 50% profit, assuming that we have a high enough credit to offset our commissions. And for us, the ideal setup we're looking for is about 1/3 the width of the wings. That gives us a nice risk to reward ratio again. And we might be able to adjust that whether we're looking to get a little closer and collecting more premium, or getting a little bit further away and increasing our probability of profit. But that's where we normally look to set up our trade for the original trade. And lastly, if we're looking for some defense mechanisms, I did do a whiteboard that covered some adjustments I might make to an iron condor, so definitely check it out. I'll include it in the description to the archive video below. But thanks again for so much for tuning in here. My name is Mike. I've got a few emails here if you've got any questions or feedback, so shoot them over, or you can follow me at DoTraderMike on Twitter. We've got Jim Schultz coming up from Theater Practice though, so stay tuned and have a great weekend.